If you can't get a loan or a mortgage to purchase a house, there is a loan scheme available with the local authority. In the case of Limerick Council, it's the local council. Um, in order to get this loan from the local authority, you must jump through a number of hoops. The first thing is that you must get refusals from two lenders in the commercial sector, for example, banks or mortgage companies, etc. You must have two refusals to show that you can't get the loan commercially, so you go to the council. The second thing is that you must be a first-time purchaser. Normally, you must be a first-time purchaser. It must be your first time purchasing a house, and you mustn't have any interest or ownership of any other house. Now, there's one exception to that. If you've gone through a marriage breakup or a breakup with your partner or a divorce, and you don't have any interest in the family home, or you don't have any interest in any other home, you may qualify as a first-time purchaser all over again. Equally, if you've been through the insolvency procedure and you've been bankrupted and lost your home, you're eligible to be considered for a local authority loan. Now, there is an income limit. In other words, you can't be earning more than a certain amount if you're to qualify for this loan. For a single person, you can't be earning more than 80,000 gross. It used to be, at the moment it's 70,000, but it's going up to 80,000 next April. For a joint application, if you're applying with your wife, your partner, you're applying together, the maximum amount you can have jointly is 85,000. And that remains unchanged. There's also a limit on the value or the price or the cost of the house that you're going to purchase. You can borrow up to 90% of the market value of the house you're purchasing. However, the house can't be, the price of the house can't be above a certain amount. In Limerick at the moment, the amount is 300,000, but it's going up to 345,000 from April, literally from next month, or the end of next month. As I say, you can borrow 90%, which means that you have to have 10% of a deposit, 10% of the value of the house as a deposit. Now, there is a scheme called the Help to Buy scheme, which you can claim back some of your tax for the past 4 years, up to a maximum of 30,000 or 10% of the value of the house, or the amount of tax you paid over 4 years, whichever is the lesser. And you can put that towards the deposit, towards the 10%. However, even in doing that, you must be able to demonstrate that you can that you have saved at least 3% of the actual deposit. So the rate of interest is quite attractive. If you're taking out a 25-year loan, the rate of interest fixed for 25 years, it won't change no matter what happens to the world economy or to the Irish economy, is 4%. If you're going for more than 25 years, the maximum is 30 years. If you're going for, say, a 30-year loan, any loan more than 25 years, again, it's a fixed rate of 4.05%, which is a very attractive rate, and it gives certainty. It may be that interest rates will come down, and it might look expensive at some stage, but at the moment, it's relatively cheap, and it is fixed, and it enables you to plan ahead, so you know exactly what you're facing for the next 25 years. Now, it applies to people age-wise. You have to be over 18 and you have to be under 70. You must be in continuous employment for the past 2 years. Continuous employment, you don't have to be with the same employer, but generally speaking, there mustn't be more than a 4-week gap between one job and another. Now, as I say, a single person can make an application, or even if they're married, they can make the application in their own name. But the fact of the matter is that if you're talking about two people, say husband and wife, or people who are living with each other as cohabitants, they can make a joint application. Usually the amount they'll be entitled to get would be about 4 times their joint gross income. Let's say, for example, their gross income is, say, 80,000, so that's 4 times 80, 320,000 maximum. The two incomes are added together. Now, there's a number of factors that could reduce the amount of the loan they'll be able to get. For example, if they have other loans, say car loans, etc., how many kids they have, Generally speaking, what will happen is they will the lending agency, the housing agency which decides on whether the loan is available, will look at the total net income coming into the house, and if the loan, the mortgage they're getting is costing more than 35% of that, which is roughly one third of that, the local authority will, the loan would, generally speaking, not be forthcoming, because people, the policy is that you don't sort of borrow money, or you don't take out a mortgage that's going to sort of leave you with too little to live on. So it's about 35%. And as I said, the 4-year rule applies. 4 years, 4 multiplied by your gross income, or gross joint income. So they're the main issues. As I say, it's first time, generally speaking, apart from the people who are divorced or the people who've been bankrupted, etc. It's for first time purchasers, and it applies to both new and second hand houses. It's not confined to new houses. It's new and second hand houses. And if you have any further queries on that, you can contact obviously the loan section of the local authority, or you can contact my office directly, and we'll help you in any way possible.